All right, we need a mic today because there's a lot of you here. So thank you so much for coming to the Northwest Arkansas Commercial Real Estate Meetup starting this September. It'll be a 2-year anniversary. So thank you all for your support. Without it, we couldn't be here almost 2 years later. Today we'll have our excellent broker panel. A lot of you have been so excited about it because it's an interesting market we're in, and we're excited to get to that as well. And before we get to the core of the panel, we just want to make sure we tell you a little about us and also our sponsors. My name is Missy Liu, one of the co-hosts along with Brian. My company is called Life Mission Capital. We help busy professionals, especially high net worth executives and also business owners, passively invest in real estate. So what we have is commercial real estate meetup, but you don't always have to handle tenants and toilets, do a lot of things yourself. You can also be part of the investment as a passive investor as well, and that's what we specialize in. And right now in this type of market, we mostly focus on debt because it's more secure compared to just being in an active position. And we're more of a conservative investor, so we like to stay in debt. And Brian, would you like to give a brief introduction of yourself?
Yeah, Brian Wagers, principal at Elevate Commercial Investment Group. We buy apartment complexes, and we do that by pooling investor capital together here locally, nationally, all over the country. So we're really excited to have you guys here today with this awesome rockstar panel and really dive into commercial real estate with regards to Northwest Arkansas. Do we want to thank ours?
Yeah, we do, definitely. Without sponsors, this would not be possible. We have 2 sponsors for the event today. We have City Title and also CoStar. If a representative from either side can come up, just talk a little about them, I would appreciate it. Also, City Title has a tap open downstairs. Even if you wanted to get a drink, hasn't gotten a drink, you can go down there at the brewery and grab a drink. And thank you, David, for supplying the food and the snacks and the water. And it was last minute, but we made it happen. Thank you.
Hi, I'm Dave with CoStar. We are the industry leader when it comes to commercial real estate data and analytics. I work with most of these fellows on the stage, including a lot of folks outside, so we can help you get more deals done, help you make better real estate decisions.
Hey, I'm Josh Hyatt with City Title. I feel like I know a lot of you in the room, worked with you guys. I won't take too much time away from this awesome panel we got up here. I want to thank these guys for coming. City Title, we're independently owned. We've been in Northwest Arkansas, I think, since 2011. I've got a great residential team if anybody needs those, but what I'm most proud of is our commercial team. We have a dedicated commercial real estate closing team that's, I think, the best. We've got dedicated title agents that are top-notch, our closing agents. We have experience, professionalism. We're extremely accurate in what we do. That's it. Thanks again for letting us be a sponsor.
Josh, and thank you, David. I also want to thank Kill William and Mike Dooley for sponsoring this location. This is a great location, close to everything, and I also want to thank Wade for helping with checking in at the check-in desk. I know it was a little overwhelming. Everyone was like towards that corner, can't come in. So thank you, Wade, for handling that. Okay, let's get started on the panel, and we can talk more about different stuff in the panel about panelists and
It might be hard to pass the mic around.
You have the loudest voice. Say something, see if people can hear you.
Zach Kuiper, Genesis Commercial. Yeah. There you go.
Great. Awesome. Great.
Yeah, does everyone want to introduce themselves real quick?
This mic may be a little hard to pass down. I may just use it here, and maybe you can just go down, starting from Clinton and come all the way here.
I'm Clinton Bennett. I've been a commercial broker in the market for about 20 years. I've got a small firm called Bennett Commercial Real Estate. We're located here in Rogersville, kind of throughout the country. Tom Allen, president of the same estate business, about 25 years. Glad to be here.
Dan Smith, Colliers, Arkansas. I specialize in land, multifamily, mostly land. Here in Arkansas since 2020. Been broker since 2009. Specialize in mostly land.
Zach Thomas with GREA. We specialize in multifamily brokerage. This will be my 12th year doing brokerage in multifamily, and in Arkansas, in Northwest Arkansas, for 3 years.
Zach Kuiper, Genesis Commercial, and a lot of retail office as well as a lot of land.
All right. Yeah, this is going to be kind of panel style. We're going to ask, all these guys have a ton of great experience in commercial real estate, and they all have experience locally. So we'll ask questions. If you guys want to expand on any of the questions, or you have anything, you can chime in throughout. This is going to be pretty open forum. You can raise your hand if you'd like. So I'll start us off. 2024 has been pretty wild, to say the least, in commercial real estate. I haven't done any deals in 2024. It's August 2024. So that's not what I was expecting, but it is where it is. So what are the major signals you guys are watching in the U.S. commercial real estate market, and how will they impact the directions of the overall market? This is regards to national factor. We'll go into regional Northwest Arkansas, but on a national level, are you guys watching interest rates, debt, elections, treasury rates? What kind of market signals are you guys keeping track of?
I think for multifamily, it's definitely supply. It's always supply and demand, but specifically for multifamily, we're seeing that Northwest Arkansas is actually trending similar to what the national trend is, which is a lot of recent supply in the market. And so you've got kind of a lull in new starts coming up behind that. So Northwest Arkansas doesn't always follow the national trend, but in my experience, I think that's what's going on right now. There's definitely been a lot of new deliveries in the last 6 to 9 months by a lack of new starts. So it'll be interesting to see how supply and demand balance out.
Yeah, I'd say right now, to build off Dan, there's a kind of a tale of two counties. Benton County, specifically Bentonville and Rogers, were really inundated with supply. That's where you're going to find the most vacancy, obviously in the Class A space. I think last I checked, vacancy is around 11%. A lot of products came online at the same time, fighting over tenants. You're starting to see concessions enter the market. There are parts of Washington County, especially East Springdale, Fayetteville, close to the campus, where vacancy is still kind of hovering around the all-time low, 98% closer to campus, or kind of core Fayetteville. The further you move out to Farmington and some of those South Fayetteville, West Fayetteville, vacancy does start to tick up a bit. But yeah, Bentonville, Rogers, those submarkets really inundated with supply. That doesn't really answer we're kind of jumping after national. But I'm sorry, feeding off it. I would say interest rates, obviously, that's kind of the big kicker for, I think everybody's kind of tracking that here, hoping for a 55th cut 30 days from now. I do think a lot of the data or the answers that we're going to give, ask us 30 days later, and it could be a completely different market, hopefully.
Yeah, and that's great info, especially on multifamily side. I know a lot of you, focus on that aspect. I know not everyone focuses on multifamily. But on the conversation of multifamily, what do you think about what's happening with bad debt? Is there an increase of bad debt in the area? Or have so many affluent people who are leaving? Things are behind, is he struggling? Higher cost of living, right? My mortgage payment has come worth anything to share on that in terms of the stress in the market from that perspective?
I have not noticed any tick up in bad debt on the deals that we are underwriting and evaluating. I saw a stat recently that if something, in 2020, the average median income to buy a house over $300,000 was $50,000, and now, just a few years later, it's jumped up to $85,000. All that to say, people are going to be renting for much longer than they have been historically. I would say, right now, Class A is as full, or Class C is as full as it's ever been, at least here locally in Northwest Arkansas. We're not seeing that tick up in bad debt. Again, I think when you look at median wages, we are above the national average kind of across the board for all submarkets.
You're talking about bad debt as like residents bad debt, or are you talking about owner bad debt?
Oh, I'm sorry. I was thinking more of a resident bad debt.
Yeah, I was thinking more of a resident bad debt, like in terms of tenants behind in payments.
Gotcha. I was thinking more like I think there was a recent foreclosure in Little Rock.
You're talking about foreclosure?
Yeah.
Okay.
I don't know if you guys is that something, I feel like that is happening nationwide, but NWA is very insulated around bad debt on the ownership side or people not being able to pay. I don't know, besides that one recent Little Rock foreclosure, I don't know if I've seen anything.
I think there's a lot of, in fact, I was listening to a podcast about Willie Walker done that yesterday, and I was kind of surprised when he did some Bentonville. I'm not a multifamily guy, so I don't know the project. But he said there was a project in Bentonville already with the problem. They stepped in with some, I don't know if the best step would be the right term, but they stepped in and kind of carried it through. So I think he said they had an 18% IRR. They made a really good return stepping in on this distressed deal. And I guess my point is, I don't think we have any distressed deals here. There may be a couple that end up in that category, and I think when they do, they're 50% of this room knows somebody that'll be at the bank waiting to help fill the gap.
Yeah.
So I think if we have problems that show up, it feels to me like the market and the capital that's interested in getting into this market is deep enough to cover those problems pretty quickly.
Right.
So I think that is, nationwide too. People are waiting for this ultimate buying opportunity, and you have this. Nationwide, there are some people that are in trouble when you have so much capital that is going into commercial real estate, more specifically multifamily. So your point exactly, it keeps those prices up where if they really have to sell, they can go sell to a hungry market that's ready to deploy. And I think that's especially true in Northwest Arkansas.
Right, so we're talking about interest rate, and speaking of interest rate, right, everyone always wants to know what the interest rate goes, especially at this time of the year with the election. And trying to stay, not too political in this channel, but where do you think the interest rate will be heading? The remainder of the year, or next year, especially with some of the distress in the commercial real estate market and recession talks, well, if we're not already in recessions. Anyone?
I don't know if this is an appropriate answer, but I think the more important, like you can kind of lock in an interest rate right now. The more important question to me is where are construction costs going? I mean, you can kind of underwrite just to the interest rates. Hopefully they go down. If they do, that'll help things. I don't think a half a basis point move in interest rates is going to make or break a project really right now. But these construction costs, I'm looking at Tom because he probably looks at a lot more than me. But I mean, it's shocking, isn't it? And the rate they've been growing. I mean, they're just killing deals and they're just going to keep doing it.
Yeah, I'll chime in. We are broke ground on the Visionaries across from Top Golf, and that's a 200,000 square foot. That was a misprint, by the way. The paper said 20,000. It's a $100 million project, 20,000 square feet. Construction costs. I was reading somewhere. I don't know if it's something you guys put out. Nationwide, it's increased by 1.5% or something like that, but it's been exponential of that here in this market. And the reasons are good reasons. We've got the world's largest company down the street building a multi-billion-dollar campus. They're glad to do it because everybody now quit saying, well, you guys are going to overturn and Walmart moves to Kansas City or Dallas, but we know that's not going to happen. And so that's put us in the spotlight, but it's also taken every concrete truck you can imagine, it's taken every laborer you can imagine, it's taken electricians, they're picking their jobs. And it's hard to get people, and also delays probably longer, which means more money because of the draws of the banks. We've got banks really asking these bankers for questions they want to do. But I agree with Clint. The interest rates are higher than I've dealt with since I've been developing. And it is a concern. But the biggest problem is construction costs, and I don't see an end to that. So we're going to be living consequentially with really high rates. And the demand is still strong. Talking to our team this morning at Sage about all this, the demand is still strong for leasing Class A space, Class B space, and everybody's realizing that they're going to be higher rents. We're going to be seeking $40+ a square foot in this new building. We've already got a tenant signed up. We've got others looking to sign up. I never thought when I entered this market, Steve, when we were doing this market plan, that I was lucky to get $17 for it. We're looking for $40+ a foot. So construction costs are a big concern.
You guys, well, the buildings just down the street, $16 a foot for each other. Yeah.
And just to speak on the construction cost and the interest rates, at the end of the day, that typically goes down to the tenant that's paying for that increase in those expenses. So in the retail world, there's a ceiling to what these tenants can pay and still make it. So we'll kind of see where that threshold. I have a feeling the new Whole Foods will kind of press that limit with a $50, $60 all-in rent. Yeah.
With regard to interest rates, construction costs, as it relates to multifamily, I mentioned the lack of new starts. I think one of the things I've been seeing is that the merchant builders are the ones that are sitting on the side. It's the family offices that are long-term holders are the ones that are building. So the guys that were looking for a quick exit on stabilization, it's just, I don't see them anymore. I don't know what y'all.
That's definitely in our case with this new building. One person financing this building probably is. It's not me. And it's a long-term hold. They're not looking to sell. And they're okay with a lesser return on investment than those other investors. We invited several investors out of this market to invest. They wanted to be here, but when they saw what the return was going to be, again, hearing about different markets and how tough office space was, they don't have to.
But that strategy, they didn't play that strategy 10 or 15 years, it's hard, right? Like if you can play the long game, the return for that.
Speaking of what kind of projections are they projecting in terms of performance, like IRR, etc., long-term or short-term hold, that for a deal for them to actually go forward when they can invest in debt, right? Like for example, we're investing in Mez debt, and it's getting our investors teams in returns, so that makes them like, I want them to get into the equity deals, but it's so hard. They're like, hey, we have to take much higher risks, especially in our area development, right? Because there's not many buildings trading. They're like, we have to take so much higher risks, potentially higher returns. Let me just park my cash in short-term debts right now. So I know some of you are dealing with more institutional clients, and or their business is growing, they need to grow. So what kind of return metrics are they looking to, like, hey, it's okay to go forward?
On the development front, we're right into a 7% yield on cost typically to just do the eye check and see if it's worth the time.
7% yield on cost.
Yeah, I would say for existing product, like Brian had mentioned, and kind of sitting at zero for the year. Unfortunately, there's a lot of groups of buyers that are still sitting at zero in terms of transactions, and the return metrics haven't necessarily changed, and that's partly why groups are patiently sitting on the sideline, trying to hit the mid to high teen IRR on the exit, and really a 2x multiple. And unfortunately, that's just been a hard nut to crack right now, which is leading to much lower transaction volume. We have not seen return thresholds or requirements diminish or increase based on the debt environment. It's just a matter of we'll be patient and wait for these interest rates to come down, or wait for the bid-ask spread to tighten a little bit, and sellers to get a little more realistic. Until then, transaction volume will continue to stay low.
And Brian, right, your team, typically how much do you do a year in terms of transactions?
3 or 4 deals.
4 deals, right? That's such a contrast, and we also have a net offering because of that to take advantage of.
Yeah, it's kind of what Lynn was mentioning with Walker Dunlops of the world. They're having that preferred equity investment. I think we're still looking for the mid-teen IRRs, 2x multiple in 5 years. That's to our investors, so it's tough to make those deals. So I guess there's some big investments going into multifamily and commercial from KKR, from Blackstone. I guess you could almost say that they are signaling a bottom. Do you think NWA is still going to increase? Do you think there's any sort of down in pricing? With interest rates, for me personally, I think with interest rates coming down, when they eventually do come down, I think that's just going to drive prices higher. Right now, we're seeing, $200,000 a door, A-class multifamily, that would trade pretty quickly right now. Detroit, $255,000 a door. You guys see new class multifamily hitting $300,000 a door.
Maybe on the BTR side, not garden style or RAB or mixed use. I would be shocked to see 300,000. But definitely the BTR townhome community. You might see that in the near future. I would say if you're hoping for kind of the Big Short 2.0, you're going to be upset. I don't believe that's going to happen. I think the bottom is behind us, or maybe we're right there in it right now, very shortly coming out on the other side. That's my opinion.
Cool. So I know all of you kind of work on different types of transactions. Let's just do a recap for the audience. And by the way, B2R is built for rent. It's built to rent. So they built for the purpose, usually single family home communities, for the purpose of renting. That's why a lot of that. So do you want to kind of go across and just talk about briefly, like what asset class do you propose transactions on? Because most people are familiar with multifamily because you own a single family and you're like, hey, next thing multifamily. But what else is awesome? I mean, the top 2 asset classes you're trading would be tenant reps. You want to start
Sure.
there?
I do a lot of retail office, really focus on retail and restaurant, and then large office buildings. Transaction activity is really at an all-time high. Has been for the last, since I've started, so about a decade. You've got a lot of new tenants wanting to come into the market, but not a whole lot of new product. It's just so competitive to get into the second generation space. We talked about construction costs. It previously was $100 a square foot to build out space. You give a tenant $50 a square foot, now those build outs are $150 a foot. That tenant has to come out of pocket $100 a square foot before they're even open. A lot of mom and pops just can't do that. So you're seeing existing deals stay full and not a whole lot of runway for the new stuff. There's just not a ton of land in their sense these days.
I was multifamily. I'm going to switch to retail now. Transaction volume is kind of at a low, at least in my 10 plus year career. Asset class will go as low as 5 to 10 units. We try to stay north of 10, but if it's townhome or BTR, we'll go as low as 10 units, upwards of no cap. We don't turn away money, so 500 plus units, we'll try and broker that. Most of what we don't do any 95% of what we do is going to be existing product. We don't actively broker land. So existing product right now, speaking of what is available in Northwest Arkansas, kind of the sub 100 unit space, value add or new construction, if you have to be north of 100 units. So when we're talking to buyers or investors, and if it has to be over 100 units for scale, tell them, well, new construction is kind of your best bet. There's still the 500-pound gorilla in the room. Not in this room, I don't think, but Lindsay sits on the majority of the value add product that is over 100 units. If you're looking for, our pitch to buyers or investors looking to enter this market who say, we need north of 100 units with a value add component, get in line, you and everybody else. It just doesn't happen here very often, maybe one or two a year on a good year, and 2024 is not a good year. But if you're willing to go in that sub 100 unit or sub 80 unit space for value add or brand new, like we're working with several merchant developers that are itching to get out of a deal now or upon stabilization. They can't get rid of it soon enough. So that's any sort of value add north of 10 units.
I do almost exclusively specializing in more multifamily land, but it's interesting to see how Northwest Arkansas has changed even in the last 4 or 5 years, because you used to have single family developers in land, had multifamily developers in land. Now you've got these single family built for rent developers that kind of wedge themselves in between, and has caused single family land to go up for sure, but it's also added another product type. It's kind of exciting to see that Rogers has now passed a new form-based code. Bentonville's in the early stages of revamping their code as well. Downtown Springdale's got a form-based code with an option to opt in to the form-based part in the area surrounding the downtown core. So I think there could be some opportunities in infill. There's going to be smaller opportunities. They're not going to be 15-acre garden style deals for in, but it gives Northwest Arkansas the opportunity to densify some. A little bit less sprawl, more dense, but we've still got some infrastructure that will have to get improved to do that. But it's been really interesting to see. I mean, the last 6 to 9 months in land has been generally slow, but with that, I will say that seller expectations have not subsided at all. So that's been interesting. I will say that it seems like sellers have gotten a little bit softer on terms. It used to seem to be that they expected these unrealistic terms for developers of a 60-day due diligence and a 60-day close or something, and something that's got to get rezoned or site plan approved or whatever. And it would seem that terms have gotten a little bit more reasonable. I don't know if that's just because of the type of sellers we're getting around to, where you've got more, I wouldn't say institutional, but more business level sellers and less individual owners. Could be that reason. I don't know. But definitely a lot going on with land for sure, and I hope to see transaction volume pick up a little bit.
I focus primarily on office is my biggest focus, and then next in line will be retail, and then a little bit of industrial, and we do some land as well. My position, I get to see all the deals. So we have brokers in the office, agents that certainly do more industrial than I do. So I'm familiar with it, but the office market is still, as I mentioned earlier, still very strong. As strong as I've seen it since I've been in the business. And what's fun now is the Walmart many years ago said building nice. And so the flight to Class A has been really interesting to see. We used to call, where's the CoStar? We used to have Class A space. There really wasn't Class A in this market, but you would take it and put it in some other city. So we truly have Class A space now in this market. We're getting there. But guess what? Well, that's really what we focus on. And I think that I'm having a down year compared to last year, but still healthy. I'm working harder than ever. I don't respond to Clinton and everybody else fast enough, or Randy. They're all looking at me when I'm going to get back to them. But it depends on who you are and how much you are to me. That's how I'm the deals are more complicated now. For whatever reason, whether it's kind of the opposite of what you just said as far as land. What I'm dealing with in office space and others, there's the TI factor, the build-out factor. I think also because there's not much space available, people are taking alternative spaces, shorter terms. And shorter terms from us commission-based brokers means less money. You do get more deals every other year or every year, but you're seeing a lot more one-year deals come out because they are thinking something's going to pop up new construction-wise later on that they can get out of their lease and move to. The problem is construction costs are so high, there's not a whole lot of new construction out there to relocate to. So we're going to continue to see higher rents for a long time. I think it does. On the first question you talked about earlier, I think that as a nation, and it still impacts us. We're in a bubble definitely here, but it still affects us. But the debt of the nation, which reflects our inflation, and if we don't get inflation, I mean, it can level out, but we've got to have prices go back to where they were to some extent, because the consumer is struggling right now, and that's going to have a trickle-down effect to everybody else. And the retailers right now are expanding, but I think it was Clinton that said, or it might have been Zach, that said they can't afford to pay for very long these in my opinion, $40 a square foot triple net on retail lease houses. You got a really good volume. really. So I worry about leasing space at these high prices, just because I don't know how long. I've been set business model that you better be prepared to regenerate that space as something else, which means multifamily for landlord in the future. But as a nation, we got to get our inflation under control. We need some interest rate reductions, and I think we will see one or two. I think that's going to help. And then also, I think that when that happens, the capital markets are going to really be turned loose. I think that we're going to see a lot of people looking to be buying some of these income producing properties with rates come down. They don't have to come down where they were. They can come back down just a little bit. I think we're going to see some activity flow.
Awesome. Yeah, sounds like multifamily is definitely, we don't have that many. And Zach with the ones restaurants, I think he opened down homegrown now, so
Go check it out.
congratulations. So definitely bring more diverse food options here. I think if we bring out more diverse food options here, we'll start
For sure.
So we can go to the lot there too. Great. So I think some things that's interesting, Clinton, wanted to ask you is about self storage, because I think you work on a few self storage transactions, right?
Yeah. Yeah, just to talk about our firm, we're kind of generalists. I don't advise people getting into brokerage business to be generalists, but we do a little bit of office, retail, and industrial. The brokers in our office, I really encourage them to be specialists. With Tom and I, Zach, as we were coming up in this market, it was small enough you can kind of be a generalist. It's grown a lot, so now it makes sense to be a specialist. Like, you really need to know what you're doing because they're great competitors in the space. So I'm a little hesitant to speak to storage. I've sold some property to people that have developed storage, but I'm hesitant to pretend I'm an expert. I do know a little bit more about the flex and industrial, but all of those properties, the projects, I mean, the demand and the rent growth and the interest in buying stabilized projects, whether it's storage or flex or industrial, it's through the roof. I mean, there's a lot of interest. Vacancy rates are super low. I think the vacancy rate for industrial now, that's just the broad category, is like 3.2%. In the early part of my career, I considered full occupancy 12%, so I don't know if you can debate what is full occupancy, but I would always think double digits for sure. And it was funny, there was a conversation, people that have been in this business the last 5 years or 8 years, like, they haven't seen anything over 5% vacancy. So this market, I don't know if I'm answering the question or saying it's useful, but it's super tight. We are now, I think, starting to see enough supply come online, and these rents are high enough. Zach was talking about the retail restaurateurs having pressures from these rents. The reality is the plumbers and the roofers and the people that are leasing the flex space, they're having the same problems. And a developer, you have to spend so much to build it. So now these flex spaces are 16, 18, 19 bucks a foot. And there's a lot coming online. I heard this morning, really probably the largest flex owner in this market, like, trying to kind of make some concessions on terms that they might not have done. When I say terms, I mean lease term that they might not have done a few years ago, last year. Some other terms of the deal that you can feel it softening up a little bit because we do have I think some growth. But I don't mean to say that to alarm anybody, because we're still at 3% vacancy. So it's going up.
Thank you.
Yeah, Zach, I had a question for you. Specifically, you kind of mentioned it before, the vacancy rate in Washington County is a lot different than Benton County. Is your strategy for multifamily development different for each markets? And, hypothetical question, if you had $10 million to develop, what submarket would you develop?
It's not hypothetical. I have $10 million to develop. Just kidding. I like where the vacancy is low, right? So I like East Springdale. Supply is low, vacancy is low. The metrics make sense, other than the rent, right? You're not able to achieve the rents in East Springdale that you can in West Springdale. It's a component of how much does your dirt cost. I would say, again, for existing product, because we don't do a ton of development, we don't work with developers. We tell them, hey, get it CO'd and call me, and we're your guys. For existing product, if I'm buying, whether it's Class A or heavy value add, I'd probably lean towards East Springdale. We're seeing just a ton of gentrification with what's going on in downtown Springdale. I think the city's making a lot of right choices. I mean, you have the Greenway, and you have all the components, the gentrification. Yeah, Onyx Coffee Shop is coming. Blue Crane's very active. Anytime I see where Blue Crane is developing, I'm going to take a special interest, and they probably spend more time researching than a lot of us do. Or maybe they just write blank checks, I don't know. But just with what's happening with George Luther Park and all the components surrounding the east side of Springdale, I think it is very ripe. The runway is, gosh, who knows, 5-10 years long. Yeah, we're long on East Springdale. So, and That's where we have the most inventory right now, both kind of on and off market. That's what I would advise. And then you really just can't go wrong in core Fayetteville with, you have a tenant factory with the campus down there. So it's generating tenants, which is obviously going to keep your occupancy up. We're seeing a significant spread between market rent and what these new developers are able to charge for kind of a one bedroom or per the bed. So many, Sweester and Pierce, they have just some kind of that old rugged product. But we're able to see new development, like tenants want the newer, nicer stuff. They're willing to pay up. It really throws off your rent comp set whenever Sweester has a $500 one bedroom unit. But we're able to lease up the $1,000 one bedroom unit because it's a nicer product and there's a pride of ownership there. I tend to say in Washington County for sure, and that I would say that's more kind of for here and now. That answer might change once there's some equilibrium in supply and demand for Benton County. Obviously, I love Bentonville. I don't think you can go wrong in Bentonville. I just wouldn't want to be delivering any units right now in Bentonville. And same with Rogers. They're fantastic markets. In 2026, if you're delivering units that are going to come online in 26 or maybe 27, I think you are well poised to have a ton of success. But right now, there's a lot of struggling in lease up. I don't know if that answers your question.
I did.
Yep.
I think the fundamentals are solid, right? You've got between 30 and 40 people living here a day. Everybody's heard that. One other thing that I've been noticing is that the owner-occupied percentage has gone from 63% in 2010, 68% in 2000 to 59% last year. So you're slowly, that's a pretty decent change in not that long of a time. So you're seeing more and more renters, some of them by choice, some of them by necessity. You've still only got four. So the four biggest home builders, again, I'm a commercial broker, but in land, you've got to understand the residential metrics. So the four biggest home builders built 50% of the homes that were sold. So you've only got one national home builder here. You've got 3 or 4 other regionals that are building. So the ability to put volume of single family homes is somewhat constricted. Bigger markets have a dozen national home builders. So I think that supply will be still somewhat constrained, and you've still got demand coming in. And so the fundamentals, long term, I think are still great.
Yeah, because Dan, you also looked from the North Carolina market.
Yep.
Also, exactly.
Dan, what would you say about infrastructure?
Sewer.
Continuing that strain, yeah.
So I've got sewer maps all over my walls, and we don't have enough sewer. We got enough water generally because that's easier, but sewer and working within municipalities is going to be key. I talked with Northwest Arkansas Council a couple weeks ago about it, and I don't see a savior in coming up with a regional system anytime soon. It would be great. But in the meantime, I think we've got to continue to evaluate cross-jurisdictional boundaries to allow for some infill development along these boundaries that don't have services currently. Good, yeah, appreciate it.
Awesome, thank you for the insights on that. Tom, I have some questions for you about Rogers' specific growth in terms of asset class and locations. Any specific asset classes really going around Rogers?
When you say asset class, are you talking within multifamily or are you talking about in the general area?
In general area, yeah.
So I'm not the multifamily expert,
Yeah.
you know that. So I'm paid for some apartments for my kids when they're in college and stuff. Obviously, I'm in the Pinnacle neighborhood day in, day out, so I know that goes back to my hand. So it is hot. People are looking to be there every day to hear somebody, whether it's Clinton or somebody here bringing a deal. We talked about it this morning, told our meeting. A lot of brokers in our office. I've got clients that want to be in Pinnacle, and I'm like, guess what? There's no space of any size. But so that's obviously a hot market. And then downtown Rogers has been very impressive with its growth. It's not on the scale to what we have out here in Pinnacle, but it's got a lot of entertainment value with restaurants and other things going on. So they've done a great job in downtown Rogers revitalizing that. They're really trying to pump something into what they call Midtown area, where the Frisco Station Mall is, that general area. So that's going to. I don't think that's really a hot spot, but I think that's where they're trying to get some things going. Of course, it got hit by the tornado the hardest, so it's going to be a long time recovery there. Asset class in Rogers, one of the things that we see, we get a lot of calls daily at our office for retail. And we have no retail of any size of inventory. We get calls from Colliers and Clinton's Group and everybody else too. And it's just really hard to offer that space. And there is some land available, but the land is expensive. And then the construction costs are high, and then the timing. Generally when a retailer's calling you, with the exception of a Trader Joe's, when a retailer's calling you, they need to make a decision quickly. And so you can't tell them, I can have that building built in 2 years. By that time, they've moved on to somewhere else because they got to strike with. So
it's easy to forget Pleasant Crossing, but I think that typically was, I'm not trying to be fair to Pleasant Crossing, but that typically was the retailer's first choice. And now they're not looking there because that's where there's room to grow.
Genesis is Pinnacle Heights.
We still have some space available, but activity's been pretty hot. The live-work units were struggling there for a substantial amount of time, but it's getting better. We're starting to lease them up, yeah.
Yeah, I wonder how you think Whole Foods development is going to have any effect on supply there, or do you think that'll be filled up pretty quickly?
Quite a bit of it's pre-leased already. It's just there's a little bit of a sticker shock with $60 square foot all in rent. I personally don't feel great about putting a tenant in there. We'll see how the sales can support it. We talk about urban sprawl. We're just not really dense enough to support those prices. There's not enough people moving in one spot.
So that's what they're going out to the market with 60 square foot. You guys are saying 40 is
well, my 40 was more office, but the same thing for retail. I coming from Walmart, I saw volumes of Walmart stores in markets like Dallas or places like that, and compared to the best stores in Arkansas, it's not close. So I worry about the volume and we're growing. I'm very much excited about Northwest Arkansas. It's got a great future, but we're just not these talk about markets that have more national home builders. There's a reason for that. We're just not that big. We're not even 600,000 people yet, but we've grown tremendously in that short time period. And you got to look at us as a per capita market. Per capita, we're just knocking it out of the park for what we have here. It is no longer a secret. We used to be the best kept secret in the United States, but now cat's out of the bag, and we're seeing it come in here. But one thing else also is the new code, the NWA. That's going to have a drastic impact and change in the area. I'm known as the anti-roundabout guy, so I'm the guy who's out of the love it.
You haven't been very effective.
That's going to change development quite a bit. If you have studied the code and seen what it is, and to their admission, they don't really know everything yet. They keep promising that they'll work with us when we find things that are going to be problematic in our development. And so I think they'll work with us, but if you do an apartment complex, it's going to be what they call a Texas wrap. Same thing with office buildings. If you build a parking deck, it's going to be a Texas wrap. That's where you build around the building. You can't see it from the street. All the parking's going to be behind the buildings. The building's going to be on the street, which is more of an urban feel. So that's going to affect the growth and where growth goes. They're narrowing down or dieting the roads. Stone Hills Parkway, for example, was 4 lanes. It's now 2 lanes. And the intent is to slow traffic down. The intent is to do all that. But I have the feeling that's going to change some shopping patterns. So we'll see how that goes. Right. That's a big thing.
Well, if you're doing structured parking, your rents are going to have to double.
What?
I said if you do structured parking, your rents are going to have to double as well.
Well, that's something else too. They haven't grown up in this market yet enough to be willing to pay for parking. So you got to kind of hide in the rent and just charge rent. But these parking structures are expensive. They're anywhere from 20,000 a spot to 40,000 a spot, depending on how you build it and what's put in there. But long term, that's what we talked about earlier with my biggest client, the Hunt family, is that it makes sense to build those structures because we're going to hold it, we're going to keep it, and we're going to have it there, and it allows more precious land to be developed and something else that's income producing rather than just having a car being parked there. But I think that when these tenants that we're putting in now, Brady, I think that when they renew, by the time they start renewing, we're going to start seeing people that are opening up the idea of paying for parking. It's just going to have to happen.
Well, I think I have 1 or 2 questions for some of them. We're going to open up 4 questions and answers. We wanted to ask you a little about the strategies and numbers behind the Tom Branch project and the Heights project.
So, assuming you're talking a little bit on the multifamily side there, which was not really involved in that, but I could talk about the retail office aspect of it. Yeah. Both of them are mixed-use properties. A little bit of a mixed income on Town Branch right there by 8th Street Market, across the street from the new home office. It's going to be a blend of income, but you got 15,000, 20,000 employees coming to the home campus, moving home. So that, expectations are for that CO to wrap up and be occupiable by the end of the year. And so expect that to lease up pretty quick. As far as Pinnacle Heights, it's right in action, premium rents, pretty much stays full. The ownership group's been great to work with. quite a few people want to be in those spots, but they want services, in the neighborhood per se, and that gives opportunity for a little bit of that. But successful, as a whole.
We can open it up to you guys if you had any questions.
Questions? Yeah, we're getting close to the last 10, 15 minutes. Skylar has a question.
Yeah, I'd like a little more discussion on the new code changes, because I've been following Rogers. Bentonville is early stages. Fayetteville has been very NIMBY and difficult to deal with. Do you see, if there's a lot more development coming in Benton County, that Washington's going to want more of that inflow and influx?
Fayetteville has a reputation, but I think every city up here has gotten tougher to work with. They all want, they're pro-business, but just the requirements, regulations, red tape's gotten stingier. Fayetteville definitely takes the cake and difficulties, but Rogers and Bentonville are not super easy either.
And they kind of wear that with pride. Like, I was in a discussion where there was talk about, I think in Northwest, I probably shouldn't speak because I haven't been in any direct conversations. But, they were talking about the idea of trying to get some consistency between cities and their code. And they're talking about trying to get some consistency between their codes. And I was in a conversation where a member of the Fayetteville staff was like, yeah, we've got no interest in that. And I was just kind of like, okay. I mean, as a person that works with developers, it seems like that would streamline things significantly and make the process better. But they didn't seem to have any interest in it. But that wasn't formal.
Sure.
I wouldn't lump Springdale in with Fayetteville. I think Springdale is very pro, from my experience.
Yeah, I think that's true.
Very pro development. Bring it on. We're ready for more units, more development. Fayetteville, I don't see them getting jealous at all. It's just they're going to stick to the NIMBY, and it's going to continue to be difficult.
I think what's going to be interesting is you've got these new codes that are very forward-thinking, form-based. What's going to be interesting is the decisions that councils make when we get a lot of neighbor opposition. Is it going to be, hey, future land use map says this, but all the neighbors come out with,
Well, form-based code, supposedly, you shouldn't be able to pull it back.
Exactly.
If it conforms with code.
So it will be interesting to see, because there's always lines. They need a variance or something like that. Well, that opens the door, to some changes. So it'll be really interesting how invested the councils are in these new codes in form-based.
I'll speak that Rogers I know best, but Rogers City Council is going to back the planning commission as much as they can. That 1% of the time I've ever seen in all my years, and I was in the City Council with Rogers for I won't say how long ago it was, a long time ago. But they're going to back what the planning commission's done, and this does take it out to your point. This new code does take a lot of the authority out of the council and the planning commission itself. A lot of more staff decisions we made. So the carrot that was dangling in front of us was it's going to be faster if it doesn't happen. But there's a whole lot more tiers. What we call it tiers. Starts with T.
Transect, yeah. Transect.
Yeah. T1 through TA, all that. But it's interesting. I've got a piece of property that's under contract right now, over there. It's actually 2 lots, but on paper, it looks like 1 lot, but it's 2 lots. And one side of it is TA, but the other side is T2. T2 is totally different from TA, so we're going to have to go and fix that. That's part of what we're hoping that they live up to their word. They say we're going to come ask you to clean some of these things that they're talking about. But I think that Rogers has been historically pretty aggressive and working well with developers and growth. It's getting a little more difficult, but not to the point where it's got a reputation yet.
Well, any other questions? Probably time for 1 or 2 more questions. John has a question.
In that multifamily space, we're talking about, one, that there's oversupply right now, but that there's a lack of starts. Talk about keeping that absorption period of time looks like until back into
I think
The motto survive to the 25, so I think maybe that's the second half of 25. I don't think it's going to take too long for equilibrium to enter the market, supply and demand to balance out. And last I looked at CoStar on a trailing 12 basis, we were only 800 or so units oversupplied, and that was really concentrated to Bentonville Rogers Class A in terms of that supply that came online. And it won't take long to reach equilibrium. I really don't think so.
I think tack on a question to that as far as rents accelerating. How long do you think it is in multifamily space before we see say $2 a foot, and then the second part, once Walmart's done, not cost stabilizing, but cost coming down on construction. Is that a feasible reality?
Well, we're already seeing $2 a foot on certain core markets. The Howard, I'm sure, I don't know, Pinnacle Heights, I haven't looked at their rents recently. Yeah, I know, that's what I'm saying. It's definitely over 2. I think Living Lofts is probably going to be over $2 a foot. $2 is kind of the new floor for new construction. It's definitely on a 1-bedroom unit. Studios are probably closer to 3. If you're anywhere in the, within a mile of 49, kind of in Rogers or Bentonville, you can't make the deal pencil, especially with the price of dirt, if your rents are under $2 a foot on some of this newer product. I'd be curious to hear as well if they think construction costs come down after the campus is over. My answer is no.
I personally say no. You got subs out there that are getting used to being paid a certain amount. I don't see that going down.
It feels like it has to a little bit, but they're going to resist it as long as they can.
Some of those guys are traveling too, right?
Yeah.
So as soon as that project's over, all those folks.
You probably see the RV parks can be out a little bit.
Yeah.
One thing I wanted to add earlier when we were talking about the cost of construction. So with our firm, and we primarily focus on existing products. In the underwriting and your operating expenses, the line item we've seen that is causing the most headache has been insurance. And unfortunately, I think that's going to continue to exacerbate the problem with the tornado. What used to be $300 a door per unit per year on underwriting, now we're pushing $800. I don't know what Brian's seeing on some of their more recent product, or when watercolors. What was the most recent? Do you know of the policy that you guys most recently signed up?
What was the question?
On insurance premiums per door.
Oh yeah, I mean, $400 a door is what we're looking at.
Yeah, which is an excellent. We're seeing $600 to $800 per door per year on insurance, and we've talked to several owners who they would like to either add to their portfolio or sell their existing, but until they get a handle on insurance, they're kind of stuck. It's really eating into the cash flow.
You guys are probably self-insured a lot more than us.
All right, well, awesome. If you guys have any other questions, some of them may be able to stay around and answer them if they don't have other questions, but we just want to give more on the class for showing that and they all bring a wide variety of expertise and the different asset classes. So really thank you for your time for being here. And so announcement, next month, we actually don't have a meetup for Northwest Arkansas Commercial Real Estate. The month after that, November, we'll have a construction related meetup with Elevate, Bill coming with Georgia Brew speaking. And but in between, we'll actually have 2 events. One of them is already sold out. That's both between me and Brian. One is called Women Demystifying Money. Some of you may not know, I'm also on the board for CRE, Commercial Real Estate for Women. So I'm a big component of women empowerment, especially in the commercial real estate space. A lot of times, many women felt intimidated being in the commercial real estate space. So but on top of that, I also love helping women demystify money. So I have an event that's already sold out, but I just wanted to let you guys know for next year, we're partnering with Arvis Bank in the board to help women understand real estate from a finance perspective, from investing, operating companies. So marketing for next year, it's already sold out for now. You're welcome to be on the wait list. You can follow me on LinkedIn to find out more about it. And also Brian is also involved with...
I'm involved with the CCC of NWA, Contractors, Closers, and Connection. We'll be having an event September 19th at the Apollo in downtown Springdale. We just started marketing about that. We'll have David Sprouse speaking in Blueprint Development. We'll be there, very focused on networking with others in the commercial real estate, very high level networking for commercial real estate investors. So I'm excited for that event.
Yeah, great. And my event is on September 17th, that Tuesday. Even though it's sold out, like I said, you can be on the wait list, and you don't have to be women to join, but we love women allies. And a lot of people there are probably more on the passive investing part, and a lot of people on that one is probably more on the active investing part. So yeah, definitely stay tuned. Hopefully you're signing, register using the QR code if you get an RSVP so that we can inform you about our next event. And thank you guys again for your time.